In 1971, something happened that changed the course of human history. Not a war, not a pandemic, not a technological breakthrough. A single decision made in secret by a handful of men in a room at Camp David. A decision that would transfer trillions of dollars from the pockets of working families into the vaults of the wealthiest humans who have ever lived. A decision that would create the conditions for every major financial crisis of the past 50 years. A decision you were never taught about in school. Because if you understood what really happened that day, if you truly understood how the modern economy actually works, you would never look at your paycheck, your savings, or your retirement account the same way again. This is the dark side of macroeconomics, the hidden mechanics that determine whether you build wealth or lose everything. The uncomfortable truths that economists won't tell you, that central bankers hope you never figure out, and that most financial advisors either don't understand themselves or are paid not to mention. Over the next 17 minutes, I'm going to explain why fewer than 60,000 people now control more wealth than 4 billion humans combined. Why your grandparents could buy a house on a single income while you struggle to make rent with two. Why every decade seems to bring a new once-in-a-lifetime financial crisis. And most importantly, what the warning signs look like right now, in April 2026, that suggest the next crash may already be in motion. If you find this valuable, consider subscribing. We cover the financial and economic forces that shape your life, but rarely make the news. Let's begin. Before I show you the warning signs of what's coming, you need to understand the system itself. Because the crash I'm about to describe won't make sense unless you first understand the lie at the heart of modern economics. Here's what they taught you. The economy is a self-correcting system. Free markets allocate resources efficiently. Central banks exist to stabilize prices and maximize employment. Inflation is caused by too much spending. Recessions are natural corrections. Here's what they didn't teach you. Since 1971, when President Nixon severed the dollar's link to gold, every major currency on Earth has become what economists call fiat money, currency backed by nothing except government decree and collective belief. This single change transformed the nature of wealth itself. Before 1971, if a government wanted to spend more than it collected in taxes, it had to borrow real money from real savers. There were constraints, limits, consequences. After 1971, central banks gained the power to create money from nothing. Not print it. That's a simplification. They create digital entries on balance sheets. They conjure purchasing power into existence with keystrokes. The Federal Reserve's balance sheet went from $882 billion before the 2008 crisis to nearly $9 trillion at its peak. They created more than $8 trillion out of thin air. Where did it go? Not into your bank account, not into wages, not into schools or hospitals or infrastructure. The overwhelming majority flowed into financial assets, stocks, bonds, real estate. The assets disproportionately owned by those who already had wealth. A 2012 Bank of England study found that 40% of the gains from their quantitative easing programs went to the richest 5% of British households. Richard Fisher, president of the Federal Reserve Bank of Dallas, admitted in 2013, cheap money has made rich people richer, but has not done quite as much for working Americans. This isn't a conspiracy theory. This is the system working exactly as designed. And it explains the single most important economic fact of your lifetime. The top 0.001%, fewer than 60,000 people, now control 3 times more wealth than the entire bottom half of humanity combined. That's 4.1 billion people. The World Inequality Report 2026 confirmed that in almost every region on Earth, the top 1% holds more wealth than the bottom 90% combined. This didn't happen by accident. It happened because of deliberate policy choices that most people don't understand. But wealth concentration is just the beginning. Because the same system that creates billionaires also creates the conditions for catastrophic collapse. And right now, in April 2026, those conditions are flashing red. Let me introduce you to the concept they don't want you to understand. Inflation is a tax, not a metaphor, not an analogy, a direct transfer of wealth from people who hold currency to people who hold assets. Here's how it works. When central banks create money and inject it into the financial system, they don't distribute it evenly. The new money enters through banks and financial institutions. It flows first to those with access: large corporations, wealthy investors, well-connected borrowers. These first receivers get to spend the new money before prices adjust. They buy assets, stocks, real estate, companies at yesterday's prices. By the time that new money works its way through the economy and reaches your paycheck, prices have already risen. You're earning the same nominal wage, but buying less with it. Your purchasing power has been quietly transferred to those who receive the money first. This is called the Cantillon effect, named after an 18th century economist who observed this exact phenomenon. It's been understood for 300 years. Yet somehow, when inflation spiked in 2022, 2023, and 2024, government officials acted shocked. Supply chains, pandemic disruptions, greedy corporations, all contributing factors. But none of them explain why the Federal Reserve's balance sheet grew by $4.8 trillion in just 2 years, and why inflation followed almost immediately. The consequences are devastating for ordinary families. According to Deloitte's 2026 analysis, the lowest earning 60% of Americans are no better off financially than they were 3 years ago. Meanwhile, high-income individuals have seen their financial well-being increase. A University of Michigan survey found that low-income Americans are far less confident about the economy than high-income Americans, a gap that widened dramatically in 2025 and continues into 2026. The Federal Reserve's own research shows that real consumer spending has grown for high-income households, but has remained flat for middle-income households and actually declined for low-income households. Meat and poultry costs have jumped 21.5%. Housing costs are up 7% for homeowners and 5.4% for renters. 1 in 3 middle-income renters now spend more than 30% of their income on housing, the threshold for being considered cost-burdened. And here's what's truly sinister. The middle class is shrinking. Just over 51% of American adults lived in middle-income households in 2023, down from 61% in 1971. That's a 10 percentage point decline. Millions of families who thought they were secure discovering they're actually closer to poverty than prosperity. But if you think inflation is the biggest threat to your financial security, you haven't seen what's happening to the national debt. Because the numbers I'm about to show you are so alarming that even the Federal Reserve Chairman is publicly warning about them. On March 17, 2026, the gross national debt of the United States exceeded $39 trillion for the first time. Let me put that in perspective. It took 200 years, from the founding of the Republic through 2 world wars, the Great Depression, the Cold War, and the creation of Social Security and Medicare, for the national debt to reach $1 trillion. That same $1 trillion is now what America pays in interest alone, every single year. Net interest payments on the national debt are projected to exceed $1 trillion in fiscal year 2026, nearly triple the $345 billion the government paid in 2020. In the first 3 months of the current fiscal year, interest payments alone reached $270 billion. That already surpasses the nation's defense spending for the same period. Federal Reserve Chairman Jerome Powell himself warned just last week, the level of the debt is not unsustainable, but the path is not sustainable. It will not end well if we don't do something fairly soon. Read that again. The chairman of the Federal Reserve, the person responsible for managing America's monetary system, is publicly warning that the current trajectory will not end well. The Congressional Budget Office projects that debt held by the public will surge from 101% of GDP today to 120% by 2036. By 2056, it could reach 175% of GDP, $168 trillion. For comparison, the post-World War II record was 106%. And here's what makes this genuinely dangerous. Several major government trust funds are approaching insolvency. The Highway Trust Fund is projected to deplete its reserves by 2028. The Social Security Retirement Trust Fund by 2032. Upon insolvency, federal law mandates spending be cut to match incoming revenue. That means an immediate 40% cut to highway spending and a 28% across-the-board cut to Social Security benefits. Tens of millions of retirees, depending on those checks, would see them slashed overnight. Maya McGuinness, president of the Committee for a Responsible Federal Budget, testified before Congress last week about what happens when this becomes unsustainable. She outlined several scenarios: a financial crisis, where investors lose confidence and interest rates spike uncontrollably; an inflation crisis, where the government prints money to pay its debts, destroying the purchasing power of savings; a currency crisis, where the dollar faces significant depreciation; an austerity crisis, where taxes surge and spending collapses simultaneously; or a default crisis, once considered unthinkable for the United States. Simply put, she said, there is no silver lining in this trajectory. If you're finding this valuable, consider subscribing. We analyze these economic forces because understanding them is the first step toward protecting yourself from their consequences. But the debt crisis isn't happening in isolation. It's colliding with something else, a market bubble that makes the dot-com crash look like a minor correction. Right now, the S&P 500 is trading at levels that have only been exceeded once in the past 150 years, during the dot-com bubble of 2000. The Buffett indicator, which measures total stock market capitalization relative to GDP, sits between 217% and 228%. Warren Buffett himself has said that a range of 75 to 90% is reasonable, and readings above 120% suggest overvaluation. We're nearly double that threshold. The CAPE ratio, the cyclically adjusted price-to-earnings ratio, reached 39.8 in early March 2026. Historically, when CAPE exceeded 39, markets averaged -4% returns over 1 year and -20% over 2 years. But here's what makes this bubble different from any that came before. 30% of the S&P 500 and 20% of the global MSCI World Index is held up by just 5 companies. That's the greatest concentration in half a century. And those companies are all betting on the same thing: artificial intelligence. AI-related investment now accounts for half of U.S. GDP growth. Companies are spending hundreds of billions of dollars on data centers, GPUs, and infrastructure based on projected returns that may never materialize. A February 2026 study from the National Bureau of Economic Research found something remarkable. Despite 90% of firms reporting no impact of AI on workplace productivity, executives projected AI to increase productivity by 1.4% and output by 0.8%. Let me say that again. 90% of companies see no productivity gains from AI, but executives keep projecting that it will pay off eventually. Sound familiar? In 1999, companies were valued based on page views and eyeballs, metrics that never translated into profits. The Nasdaq crashed 80%. A report from MIT's Media Lab found that $30 to $40 billion in enterprise AI investment has resulted in 95% of organizations getting zero return. Sam Altman, CEO of OpenAI and the man who created ChatGPT, admitted in 2025 that he believes an AI bubble is ongoing. Ray Dalio, co-chief investment officer of Bridgewater Associates, the world's largest hedge fund, said current AI investment levels are very similar to the dot-com bubble. The Bank of England and International Monetary Fund have both warned about AI overvaluation potentially causing a global market correction. And here's the critical risk: Meta, Alphabet, and Oracle will need to raise $86 billion combined in 2026 alone, according to Société Générale. They're financing AI bets with debt. If the AI narrative changes, if investors start asking, when will this actually pay off? Those highly leveraged bets could unwind very quickly. Capital Economics has forecast that an AI-fueled stock market bubble will burst in 2026 as higher interest rates and elevated inflation weigh down equity valuations. The potential fallout? The Nasdaq dropped 80% after the dot-com crash, wiping out $6 trillion in value. The economy fell into recession. It took 7 years for the S&P 500 to recover. Some analysts believe that because there's more money in AI today than there was in internet stocks in 2000, the eventual fallout could be worse. But there's one more factor that could accelerate all of this: a geopolitical shock that's already underway. As I'm recording this in April 2026, the United States is 6 weeks into Operation Epic Fury. a military conflict with Iran that has sent oil prices surging more than 60% in a single month. Brent crude peaked at $126 per barrel. The Strait of Hormuz, through which 20% of the world's oil passes, has been effectively closed to most traffic. Gas prices in America have exceeded $4 per gallon and are climbing toward $4.50. The IEA was forced to release 400 million barrels from emergency reserves, the largest release in history. And this is happening while the national debt exceeds $39 trillion, interest payments exceed $1 trillion, annually stock valuations are at their second highest level in 150 years, consumer sentiment has collapsed to levels historically associated with recession. The Federal Reserve is trapped between fighting inflation and supporting growth. Moody's machine learning recession model, which has correctly predicted every recession since 1945 once it crossed 50%, currently sits at 49%. One bad data point from crossing the threshold. The University of Michigan Consumer Sentiment Index fell to 53.3 in March 2026, a level historically associated with either an active recession or the immediate approach of one. A YouGov poll found that 40% of Americans believe an economic collapse is coming. The closest historical analog to 2026 is 1973, an oil supply shock driven by geopolitical conflict, a Federal Reserve already behind the inflation curve, and a weakening dollar amplifying the inflationary impulse. That crisis led to the worst stagflationary period in modern American history. Unemployment peaked at 9%. Inflation topped 14%. It took nearly a decade to recover. We may be watching the same pattern unfold in real time. Here's what they won't tell you on financial news networks. The system is not designed to create widespread prosperity. It's designed to create asset inflation that benefits those who already own assets. The debt is not a problem for tomorrow. It's a structural crisis with consequences that will unfold over the next decade, cutting Social Security, collapsing infrastructure spending, forcing impossible choices between defaults and inflation. The stock market is not a reflection of economic health. It's a reflection of monetary policy and investor sentiment, both of which can shift overnight. And the professionals managing your retirement accounts, setting monetary policy, and crafting economic legislation are not operating with your interests as their primary concern. I'm not telling you this to frighten you. I'm telling you this because understanding the system is the first step toward navigating it. The people who lose everything in crashes are those who believe the narratives without questioning them, who trusted institutions that were never designed to protect them, who learned too late that the rules they thought governed the economy were fictions told to keep them compliant. The people who survive, and even thrive, are those who understood the dark side of macroeconomics before it mattered. Before the crash, you now have that understanding. What you do with it is up to you. If this video gave you perspective you won't find anywhere else, consider subscribing. We cover the economic and financial forces that shape your world but rarely make the headlines. I'll see you in the next one. The few who understand the system will either be so interested in its profits or so dependent on its favors that there will be no opposition from that class. Attributed to Mayer Amschel Rothschild, 1744 to 1812.